Hello and welcome to another edition of the Friday Market Update. We've got a lot to cover today. So, question for you. Do you shop at Walmart? This could have something to do with mortgage rates down the road, and we'll get into that in about a minute. So, however, we had a very nice week for mortgage rates this week, dipping down just below 7%. We're getting really excited midweek before popping up just above it. It's like 7.11% right now. So we'll take it. We've had a very nice rally over the last couple of weeks with rates coming down off of their peak at 7.52% on April 25th. And we're just going to see this gradual decline, in my opinion. So the last couple of days have been a little bit of profit taken from Wall Street and just taking a little bit of a breather from the slide downward. So I think it'll continue downward as we get further into the year. So this was an important week with inflation data. And while we didn't expect anything earth-shattering on the downside, we were just kind of holding our breath, hoping it wasn't going to go up and derail the gradual decline in rates. So fortunately, it came in pretty much as expected with the core CPI, the Fed's favorite indicator of inflation, going down from 3.8% to 3.6%. We still have a long ways to go to get to the Fed's target of 2%. But here's the most interesting thing about inflation at the moment. So there are over 100,000 data points that make up the CPI, including housing, transportation, food and beverage, medical care, education, recreation, apparel, and other goods and services. And right now, this is really crazy. Right now, there's only two components that make up 3.3% of the entire 3.6% core CPI. And you know what that is? It's shelter and motor vehicle insurance. Motor vehicle insurance, we've talked a little bit about that, but shelter is the biggest component, and that is really making up the biggest impact on inflation. And all other components only make up that last 0.3%. So if it weren't for the lack of the shelter and the motor vehicle and the fancy new cars with all the cameras and high-tech auto components, inflation is actually pretty much intact. When will that come down? Gosh, I hope it comes down soon, but I don't know. It's going to be kind of sticky, I think, for a while. So inflation has acted, in my opinion, as kind of a beat-down effect on the consumer. While 3.6% doesn't sound that bad, it's been the accumulated effect that has been troublesome for the consumer. So not only has a credit card debt gone up by over 50%, since 2021 to well over $1.2 trillion, the consumer is now paying as high as 25% interest on credit cards instead of the 14% that it was just a few years ago. I mean, yikes, stop it. So you tell me, is the consumer and the economy really that good when people are actually borrowing money at these high rates? Or is a consumer just trying to get by until something turns around and rates come down? So furthermore, seriously delinquent credit card debt has gone up from 3% to 7%, more than double. And auto delinquencies have gone up from 1.5% to 3%, also double. This is not a good sign and another indicator that the consumer is just being squeezed and stretched. So now, back to my question earlier, whether or not you buy at Walmart. A lot of people buy at Walmart. No problem. I like it. It's been a good store. But Walmart just reported earnings and they were very strong. Walmart typically thrives in a recessionary period because of the low cost pricing structure that they have. So they are now seeing more upper class individuals buying in Walmart, trading down a little bit to take advantage of the lower price structure. So this is another sign that the consumer is struggling. It's not all peaches and cream for everyone right now. And how long can people survive on credit with very little savings? And those savings are going down. I don't know. We're going to have to see what happens there. But that said, one way to get out of it, I just had a buyer consultation who had $180,000 in credit card debt and car loans and all the debt combined in addition to their mortgage. The good news was they bought the home 4 years ago. They have now decided to sell the home. They're going to pay off everything, all their debt. They're going to put $90,000 into the bank as reserves, and they're going from monthly payments of almost $10,000 a month down to about $4,300 a month. Oh, that's like $5,000 plus savings and no debt, nothing, and $90,000 in the bank. So there are likely other families out there that may be in a similar situation, maybe not quite as much, but it is out there. And this is an option for them to potentially make their ability to sleep at night better by getting out of debt, buying another home, putting money in the bank, getting a lower actual monthly debt payments, and make it so much easier for them. So as always, feel free to reach out to me directly to get your buyers pre-approved and educated so they can make the right decision for them. You can also send them to my calendar link where I will go through a free CIA analysis, credit, income, assets, so they know exactly where they stand now and what they need to do to get into a home. So let's run their numbers. Hope you have an awesome weekend, and we'll see you next week. This is Gaylord out. Bye, everybody.